Due next Monday. Okay, math exam is due on Monday the 2nd, and actually all class material. So if you have anything to make up, it is also due on. It's also due on Monday. So the magic date for the class is Monday. 5/2. So the exam will be due on Monday. All the class materials are due on Monday, 5/2. Question on that thing? Okay. Let me save that. Actually, before I go any further, I'm going to make sure that I have everything that needs to be submitted on here. So there is no. But that's the end of the semester. Oops. And just so you know, the turning in the grades, I cannot turn the grades in piecemeal. And what I mean by that is, if I have two students in class, Amy and Bill, I can't just send in the grades for Amy and not for Bill. So they all have to go in at once. There's also a time thing that you run up against, and that is that people may have a prerequisite before they can be admitted into another class. So people taking classes in the summer, they have to get that prerequisite in before that they'll be allowed to enter that class. So there is a time constraint for not just for the whole class to get those in. The reason I say that is, if integrate now, I can go back for about a week later to change the grades. So if the grades go in, it is possible, given circumstances, that people in the hospital and all kinds of stuff. But generally speaking, though, those tests have to go. The grades have to go in pretty quickly, so that people can get cleared to go into their next classes. So it isn't just gee, I want to turn them in early or anything like that. So there's actually a reason for it. Okay. Well, let's look at the chapter 17 handout. And a lot of the stuff for the reports themselves, they're rearranging the order a little bit, but the stuff included in them is pretty much the same. There's other stuff that goes with it now that's getting more and more complex, and that's what kind of this first page we're going to look at. So the unmodified standard report. Okay. To issue the report, these are some of the rules. There's a few of them here. Okay, the first one, out of a complete set of general purpose financial statements, comparative, and the audit is not a group audit. Okay, so what does that first one mean? This one means that you are doing all of the financial statements. Can you get an audit done of just the income statement? Yeah, you actually can, but it's a different audit report. So there's a complete set of financial statements. That's the income statement, statement of retained earnings, or statement of changes in equity, balance sheet, statement of cash flows. So those are the complete set of financial statements. Again, can you have it done on one, on just the balance sheet? Yes, you can. It's a different report. You can't use this report. And the second one about the group audit. A group audit is when you have a company that owns little companies, and those little companies are operated by themselves. They could have different auditors audit them. So let's say IBM buys a little startup company called, I don't know, Tiny Tech. So IBM buys up Tiny Tech. Tiny Tech has their own auditors. That Tiny Tech audit would be part of the audit of IBM because IBM owns them. That would be a group audit. So they're saying, okay, this is not a group audit. Right, so that's what they're saying with that second part there. This one, this is not a group audit. In other words, we don't have Tiny Tech, as part of IBM's audit. Management must take responsibility. So management must take responsibility. If management does not take responsibility, you can't issue a report. Audit engagement, blah, blah, blah. Well, that one did. So management's responsibility. Management is basically responsible for the financial statements and internal controls. So management must acknowledge they are responsible for those things. This is only for clean audits. So this is an unmodified. In other words, everything is okay. Based on that, I conclude that there are no conditions, events concerning that are about continuing as a going concern for a reasonable period of time. Okay, now this is somewhat new. Okay, so this is when a company is going bankrupt. Client may be going bankrupt. Oops. Okay, now here is why that's in the past, having that statement and having a statement client may go bankrupt wouldn't change the opinion of the report, and it still might not. But here's the problem with here's the uncertainty about a company going bankrupt, and that is if you think they're going to go bankrupt in the next year, does it make sense to depreciate their equipment over the next 10 years? Right. So it might change your accounting method from, say, GAAP to being what would be called liquidation. Okay, when they actually sell off these assets, okay, we know this equipment, you bought it at this time and it's going to last. How much is this equipment worth to this year? Because you're probably going to end up selling it this year. So you might have to change the method that they use for accounting from GAAP, as we know it, to a liquidation method. Now, this is going to be more confusing. If they do, there are other methods that you can use if you're not publicly traded. It's very common to have cash basis or modified cash basis and that sort of thing to use. And there's you can put it, if you put it in the report, that's fine. But in this case, you have a company that is presumably still working on the idea of being a going concern, even though they may be going bankrupt. Okay. As they obtain all other information. Did I send out an audit report? I can't remember. Did I send out the? I don't think I did. Send out the GE annual report. I just want to make sure it went through. It did not. Okay, let me send it out again. I'm sorry.
It did go through.
Oh, did it? How come I didn't get it? Oh, well. All right. Well, if you guys got it, that's all that matters. Okay. Let me go ahead and pull it up. Okay, so this, when they talk about other information, this is an annual report. This is for General Electric. And General Electric is probably one of the more complex companies. But any annual report, you'll see a bunch of information. And about halfway down the report, you'll get to the financial statements and the auditor's report. So about halfway down, and these annual reports are, they can be anywhere from 40 pages to 400 pages. But usually if you go down about halfway, that's what the financial statements are. And sometimes they have the audit report at the end of the financial statement. Sometimes they have it at the end of the footnote. Sometimes they have it at the beginning. At the beginning is probably the most common, but again, it's not always that way. And so here is their audit report, and we're going to get to the audit report later on. So, okay, so it looks like on page 52, for the independent auditors to shareholders, and they start out right off with the opinion. That's the way they do it now. Same thing as before, but they put the opinion in the beginning because everyone will get the audit report and then go to the end of it to see what the opinion was. So they said, okay, why don't we just put that first and then put the rest of the stuff. So anyway, they go through here, and you'll after a few So here's the light and touche, and they sign off on the report. And here are the financial statements after it. Now, all this other information up here, let's see if this one. So what was this, page 35? So first on page 35, there's a bunch of information on here about, I don't know, whatever this is, future benefit reserve, blah, blah, blah. But anyway, one of the things that you do after you get done with doing the audit of the financial statements is you check to make sure this other information that they're putting out with it matches with what you have on the financial statements you just audited. So for instance, if they're saying that their sales were $13 billion and you look at it and you say, no, their sales were 11 billion. Well, there's a mismatch. So this other information, well, technically you are not offering an opinion on the entire audit, annual report, just the financial statements. But one of the things that you're required to do is to look and see if what's on your financial statements match up with this other material that's on the report. And if it doesn't, and they won't change it, you can withhold the report, because it'd be misleading to have 13 billion in the other part, then they only have 11 billion in for the audited financial statements. So anyway, so when they talk about other material, it's all this other stuff that they have up here, research and development, and all this kind of stuff. All that stuff must also comply with the numbers that are on the audit report. And here's a weird one. The auditor has not been engaged to communicate key audit matters. And we'll talk about that in a minute when we get to the key audit matters part. Okay, and just like the other report we just looked at, it starts out with an opinion. And here's the actual opinion. This is sort of the intro. We used to call the introduction. And then they hit you right with the opinion, because that's probably what you're looking for. Financial statements present fairly, we don't say accurately, in all material respects. Financial position, this is just the balance sheet. They just say balance sheet. I don't know why. Financial position is what they use in there. You will find companies that actually, or CPA firms that actually say balance sheet. But the one released by the AICPA says financial position. Results of operations, that's the income statement. Results of operations are the same thing as income statement. Cash flow is just cash flow. Accordance with accounting principles generally accepted in the United States. So this is your GAAP. Oops. Now, we already went through this before. We can go through a little bit again, though. Our basis for an opinion. And basically, your opinion can only be based on your evidence that you gathered through your audit. It can't be based on anything else. It can't be based on promises by somebody else, or that kind of. It has to be based on that you gathered enough evidence to form your own opinion. And down here it says that. The audit evidence that we've obtained is sufficient and appropriate. Provide a basis for our, so audit evidence is the only thing you can base it on. Okay, manager responsible for the representation of, let's highlight these. Okay, so manager is responsible for the financial statements and internal control. Auditor responsibility, and this goes into to obtain reasonable assurance. We talked about this before. Are free of material misstatement. Oops. And again, we don't get absolute assurance, and we don't talk about all misstatements. So we get reasonable assurance, and that they are, and we're only looking for material misstatements. They might be misstated, but we're only looking for material misstatements. High level, it's a reasonable assurance is a high level, but not absolute. Okay. Here's that other information we talked about just now. So this would be at the end of the audit. Report on other legal regulatory requirements. Okay, it's possible that this audit is used for other things too, for regulators and that sort of thing. It might be a not-for-profit or something. Looks like I'm tipping over or something here. I'm actually not, but I'm making a word. The heck? All right. The ship is no longer tilting. So anyway, it could be for other government agencies. There might be other things in there for grants and all that kind of stuff that they have to comply with. And then we have these key audit matters. And these key audit matters are they're fairly new. And they're the most significant things given to those in charge of government. And basically, these are usually done by agreement. You don't have to have key audit matters in there. Usually it's between you and the client. Now, it might be that the bank that the client is using wants to see the key audit matters. And in those cases, you put it in the report because the client would want those put in the report because that's what the bank is asking them for. So key audit matters are those things. They're the main things that have been communicated to the upper management and to more likely to the people on the audit committee. That those are the things that you put in there. And again, these are not in all audit reports. Only those that are it's agreed upon that you put those in. And there are extra stuff that is basically considerations that were made. It's a little more information, people reading it. Signature of the audit firm, no surprise there. The city and state the audit report is made in, the date of the audit report. So that is the AICPA audit report. We've kind of gone over this before. There are some people using the one that has the opinion at the end, but it looks like they, along with the PCAOB, are not putting it in the front. So I would assume that this is going to be the way it is in the future. Okay, Now we're going to go to the PCAOB report. This is on page 4. You'll notice it says registered accounting firm. I think we talked about this before, and that is, who do you send this to? You do not send this report to management. It's generally sent to shareholders and the board of directors and people who are outside the company, not management. Management made the financial statements. Management should know, about the financial statements since they're the ones that made it. So we do not send this report to management. Now, there are some, it isn't that nobody in the company, would have a reason to look at these, because there may be things like profit sharing and all that kind of stuff. The people who are not management and not making the financial statements might be interested, and they say, okay, there's profit sharing and we get, whatever percentages of the profit. And so it isn't that there aren't any invested people that will get this, but generally you don't put that into the to who is going to, usually for people outside the company. Okay, kind of same thing we just did. A lot of the wording is very similar. And they have similar, the key audit matters. We have critical audit matters for PCAOB called CAMs. So this is kind of new. So key audit matters are for the AICPA. Critical audit matters are for the PCAOB reports. So, it's they're kind of very similar in that they have, sort of like, by the way, there's this really, there's a really big part of the audit that we had to look at and we were unsure about or whatever. So in both cases, it's additional information, and it's there to give the reader a little more insight into the company. But key audit matters are for AICPA. Those are optional. The critical audit matters are not. Now, it might be that they don't have any, but if they do, they are supposed to communicate those. And here are the now, in both these cases, it does not change the opinion. It just says that, we're looking at the disclosures that are materials with financial statements, and especially challenging subjective or complex judgments. Some of the things that have to do with judgment are due to things that are unknown. If you're trying to evaluate, if let's say that you have a drug company that has all these patents on drugs, and once they create a patent on drug, they have 20 years to whatever. Well, it's really hard to predict that. How long that's going to be worth, that it's going to be out there. It could be that there's a problem with the drug. It could be that, they release this drug and 2 years later, somebody else releases a drug that's much better than it. And so there's a lot of things that go into these these judgments that are simply because you don't have a crystal ball. And so those are the kind of things that you would communicate. Okay, and then here's a whole list of things that, things you can put in there. And a lot of these are, again, they're because we don't have a crystal ball. Now, if you do find a CAM, critical audit matter, mess it up like I just did. No, you don't mess it up like I just did. Oops. You mess it up twice like I just did. You tell what the matter is. Considerations. You tell about which financial statement accounts they relate to, and tell what you did with it. Now, everything is the same for PCOB, except for this one. It's a little bit curious. You must also put in there that you have served as the company's auditor since whatever year. So AICPA, you sign it, tell what city you were in, what state, and what the date is. You do the same thing for the PCOB, but you also tell them how long you've been their auditor. And that brings me to this one, and why this one is somewhat interesting. If I can find it. Hey. You guys can't do what I'm seeing, so let me show you. Apologize for my. So General Electric, KPMG has been their auditor since 1909. That's before the First World War. You know, when they were their auditor, we hadn't had a World War yet. So from 1909 to 2020, they've been their client for at that point it was 111 years. That's a good client. You for 111 years. Okay. Oops, not that. Okay, emphasis of a matter. So you can take a paragraph on for emphasis of a matter. Emphasis of a matter are things that have already been disclosed. So we've already they're already disclosed, we're emphasizing them. So for instance, it could be that their revenues drop by 20%. It'll be in the financial statements, but you can put that in the report and say, oh, by the way, look at these revenues. The revenues have dropped by 20%. So emphasis of matter are those things that have already been disclosed in the notes of the financial statements or in the financial statements themselves. But you want to tell the readers, say, look, and it doesn't change the opinion. Okay. Now, the unmodified opinion, it could be a modified opinion, especially if there is uncertainty, which a lot of times is for bankruptcies. That it's possible that the uncertainty could get it a qualified opinion to the paragraph. But anyway, let's go ahead and look at these. So going concern, and part of the reason why you may put something like that in there is it's possible that they should be using the liquidation basis of accounting. So this is when the client period of time. Let me change it. Okay, this was kind of important that reasonable period of time. In the past, it used to be that they're likely to go bankrupt within a year, and you couldn't go out further than a year. The new rules are it has to be at least a year. It could go out more years. So if you think that they're going to last about 18 months, you can give them a going concern. Like I say, in the past, it had to be within the next year. The new rules are expanded. The international standards are 2 years. But anyway, so it cannot be less than 12 months. Okay. Unmodified opinion. The accepted kind principle is not consistently applied. So GAAP is being used, but not consistently. That's what this one's talking about. So they're using GAAP, but it's not being consistently applied. So an example. New accounting rules being followed by the client. So when a new accounting rule comes out, notice that whatever the company was using last year is not the rule. The new rule comes out is gonna be different, right? There usually is. You put that in your audit report. Now, it'll also be in the footnotes of the financial statements. It'll also be reflected in the financial statement. So it's already been reported, but you put this in the audit report and say, oh, by the way, you know, this new accounting rule for pensions or whatever it is just came out and they're following it. So not being consistently applied. It could also be that the company changes from, say, LIFO to FIFO. If they have a good reason to do it, you know, or maybe the auditors told them to do it. You'll put that in there. So it isn't that they're not using GAAP. If they're not using GAAP, they get a bad report. If they're using GAAP, it's just not consistent. And it might be not consistent because the accounting rule came out. Obviously, the financial statements from last year won't have that rule in it. Okay. So these are audit discretionary circumstances. These may be CAMs or CAMs, I guess. CAMs with a K or CAMs with a C. I'm not gonna go into it, but issue for uncertainties, for instance, COVID. I'm sure there were a lot of these. You know, you had someone running a restaurant, and one of the things you might say is, "Oh, by the way, you never know what's coming to the restaurant for the next year." Against the matter for additional circumstances. I'm not sure what I have that in for. It could just be. I assume that that's just a kind of a cleanup one. Anything you want to, anything other than for the uncertainties that you want to put in there. I'll look that up. It won't be on the exam. Let's see what I have that in there for. Let's go to. This could be for right after year end. For example, let's say that your client, you know, in January they sell off, you know, let's say they make shoes and socks. Okay, they're making shoes and socks for 100 years, and they sell off the sock line in January. Now notice the financial statements going up through December 31st, they have the shoes and the socks together, but after January, they get rid of the sock line. So the financial statements may be correct for the two businesses, but you may want to tell the reader, look, next year, don't expect anything from the sock division because it's gone. Because, you know, one of the things we use about, they talk about, you know, financial statements is you kind of try to use them to not predict the future, but make an educated decision about the future. And it may be good to know that, oh, by the way, the sock division is no longer here. Or maybe they merged with somebody. Oh, by the way, the company's twice as big. So it could be you sell a company division, you know, and tell people don't look for that next year. It could be you merge with a competitor. Oh, by the way, we're twice as big as we were before. Okay. So group financial statements. I guess I should probably. Okay, so IBM owns Tiny Tech, and there's 2 different auditors. Um, so if you're the group if you're the main auditor, the group auditor, you may include the audit of the other CPA firm in the audit report, or not. If you don't include them in the audit report, you take responsibility for the entire thing, including their audit of Tiny Tech. So you have that choice to make. A lot of times companies will insist that you don't include them just because they don't want to have a bunch of names all over the report and it looks messy and people ask questions and so they have that choice to make. By the way, international standards do not allow you to list the other CPA firm. They say, no, you have to take responsibility for the entire company no matter what. So this is a US standard only. Okay, component owner's opinion. Okay. So the smaller company audit, component auditor, Tiny Tech, maybe material Tiny Tech is $1 million because they're not very big. But IBM, who they make billions, $1 million is not material to them. So even though you might get a bad report, adverse opinion or whatever for the small component company, it might be completely immaterial to the parent company. So just because there is a material misstatement on the component company, the small company, Tiny Tech, does not necessarily mean that you have to have that same threshold for the parent company. In fact, you probably won't. So if something is misstated by $5 million, probably doesn't really matter to IBM. So they could have two different opinions. Okay, let's just push right through here. We can do these. Go through without a break. Then we'll be done. Qualified opinion. Except for. There's a material misstatement, but not pervasive. One account is impacted by the statement. So it could be one or two accounts, but actually one or two. Okay, so not pervasive. In other words, the rest of the financial statements are fairly presented. Let me say, okay, there's a problem here with the inventory account. However, the rest of the financial statements are okay. So you can rely on the cash, the accounts receivable, the equipment, the accounts payable, the revenues. So it's when there is a misstatement, a material misstatement, but that it's not pervasive. It's not throughout the whole financial statements. As a whole, the financial statements are fairly presented. Okay. Adverse opinion. You have a statement that is pervasive. They're not GAAP. Actual statements are not fairly presented and cannot be relied upon. Been through these before. And the last one, disclaimer of an opinion. This one, even though it's listed as an opinion, it really is no opinion. And this is when no opinion. And I'll tell you one more weird one. So if you find out you did the audit, you find out the CPA firm, either the firm itself was not independent, or the key people working on the audit were not independent, covered members, for example, you cannot issue any other report other than this disclaimer. Because the disclaimer is that you are not independent, you cannot issue a report. So if you find that you are not, the firm is not independent, or that a key person on the audit was not independent. If someone is not a key person on the audit, it's possible that you can go back and try to replicate what they did and see if it's, have somebody else who is independent, go back and replicate the work. But if it's somebody making judgment decisions was not independent, then you have to issue a disclaimer. So if you're not independent, it's a disclaimer. I think that's it, isn't it? Hey, that's it for the class. Woo! Okay. All right, so I will send out the last exam within probably 10-15 minutes. And it must be turned in by next Monday. And it's only over chapters 7 and 17. And they're asking questions. Any questions?
No.
Okay, well, thanks guys, and I won't be seeing you next week. Have a good break, and hopefully have you again.
Thank you so much.
Okay. Thanks.